Here's something I see all the time. Business owners paying way more in taxes than they need to. Not because they're doing anything wrong, not because they have a bad CPA, because they're confusing tax prep with tax planning. And that difference, it can cost you hundreds of thousands of dollars over a few years. I'm Matt Losanno with Cinder Wealth. In this video, I'm going to walk through the 5 most common tax planning mistakes business owners make and what you can do about them. Let's start with the biggest mistake. Thinking tax preparation and tax planning are the same thing. They're not. Tax preparation is backward looking. It's filing last year's return, making sure everything's documented correctly, reporting your income and your deductions accurately. And that's important and you need it. Tax planning is forward looking. It's asking questions like, how should we structure my income this year? Should I change my entity type? Should I set up a retirement plan to defer taxes? Should I make a capital purchase before year end? Should I accelerate or defer revenue based on what's coming next year? Most CPAs are focused on compliance, making sure your taxes get filed right. That's their job. But compliance and proactive planning are 2 different skill sets. Here's a simple test. When was the last time your CPA called you in June or July and said, here's what we should think about doing before December 31st to reduce your tax bill? If the answer is never, you're probably getting tax prep, not tax planning. And look, I'm not saying your CPA is bad at their job. Most CPAs are set up for compliance, not proactive strategy. If you want proactive planning, you need to either ask for it or find advisors who do it as part of their service. Mistake number 1, operating under the wrong entity structure. A lot of business owners set up as an LLC or an S Corp years ago because someone told them to. And maybe at the time that was the right move. But as your business grows or as your goals change, the optimal entity structure can change too. I had a client setting up a new business. They expected it to be worth about $50 million in 5 years. Their plan was to sell it. However, their attorney said, set it up as a partnership for liability protection. Their CPA said, set it up as an S Corp to minimize income taxes during the operations. Both made sense from their individual perspectives. But I asked the client, what's your exit plan? And they wanted to sell it in 5 years. So we structured it as a C Corp to take advantage of small business stock rules under Section 1202. And here's why that mattered. If you hold C Corp stock for at least 5 years, each owner can potentially exclude up to $10 million in capital gains when they sell, meaning they pay 0 federal tax on that amount. We made the husband, wife, brother, and the brother's wife all owners. That's 4 $10 million exclusions, potentially $40 million in capital gains that wouldn't be taxed. If we'd gone with the S Corp or partnership structure, they wouldn't benefit from that at all. Now, C Corps aren't always the answer. Sometimes S Corps are better. Sometimes LLCs make sense. The point is, your entity structure should align with your goals, and those goals change over time. What's the mistake? Setting up an entity once and never revisiting it. The solution, review your entity structure with your CPA and attorney every few years, especially if your revenue or exit timeline changes. Mistake number 2, maxing out your 401k and thinking that's all you can do. If you're a high-earning business owner, let's say you're making $600,000-700,000 or more, a 401k is a great start, but it's not the end of the road. In 2025, you can contribute $77,500 to a 401k with a profit sharing contribution as well, if you're over 50. That's great. But if you're in the top tax bracket, you're still paying tax on the other $600,000 a year you're earning. And that's exactly where a cash balance plan comes in. Cash balance plan is a type of defined benefit plan. Depending on your age and income, you might be able to contribute $100,000 to $300,000 or even more per year on top of your 401k. I had a client who layered in a cash balance plan on top of their 401k. They were able to defer over $350,000 in taxable income annually. That's roughly $150,000 in tax savings every year at their tax rate. Now, cash balance plans aren't right for everyone. They're complex. They require consistent funding for at least 3 years. But for the right business owner, they're one of the most powerful tax deferral tools available. So what's the mistake? Assuming your 401k is a ceiling for retirement contributions. And what's the solution? Talk to your CPA and or your financial advisor about whether a cash balance plan or other advanced retirement strategy makes sense for your situation. Mistake number 3, your advisors aren't coordinating with each other. And honestly, this might be the most expensive mistake on the list. And here's what I mean. You've got a CPA handling taxes, an attorney who drafted your operating agreement or your will, maybe a financial advisor managing some investments, maybe an insurance agent who sold you a life insurance policy a few years ago. Each of these people is probably good at what they do, but if they're not talking to each other, things fall through the cracks. I've reviewed buy-sell agreements where the attorney drafted the legal document, the insurance agent sold the policy, but nobody checked whether the policy titling matched the legal structure. Result, the agreement could have triggered millions in unnecessary estate taxes because of the Supreme Court case called Connolly v. US, all because the advisors weren't coordinating. Or I've seen situations where a CPA recommends one entity structure for tax purposes, but the attorney set up something different for liability purposes, and the financial advisor didn't even know what the entity structure was. That's not a competence problem, that's a coordination problem. What I find in the industry is that most CPAs, attorneys, and advisors don't communicate, or if they do, it's very minimal. That's the gap we fill at Cinder Wealth. We coordinate with your attorney and your CPA to make sure everything works together. So the mistake? Assuming your advisors are naturally coordinating behind the scenes. Solution? Ask for it. Get your CPA, attorney, and financial advisor on a call, or at least an email thread once a year, or hire advisors who make coordination part of their process. All right, mistake number 4, waiting until December to start thinking about your taxes. By December, most of your options are gone. You can make some last minute moves, buy equipment, defer revenue, accelerate expenses, but the big strategies, those need time. Cash balance plan take a month to set up. Entity changes need to happen early in the year. Estate planning strategies like gifting business shares need to be done well in advance to avoid IRS scrutiny. Here's what proactive planning looks like. In Q1, review last year's return. Identify what went wrong or what opportunities were missed. Q2, make projections for this year. Model out different scenarios based off your expected income. In Q3, implement strategies like retirement plans, adjust your entity structure, coordinate with your attorney on estate moves. Q4, fine-tune it. Make final adjustments before December 31st. That's planning, not scrambling in December. So the mistake is treating taxes as a year-end problem. The solution is building a planning calendar with your CPA. Check in quarterly, not annually. Mistake number 5, and this is a big one, not planning for your exit early enough. Whether you're selling your business, transitioning it to a family, or doing some kind of internal buyout, planning affects your taxes in a massive way. But here's the thing, a lot of the strategies that can save you hundreds of thousands or even millions in taxes, they need 3 to 5 years to really work. Estate freeze strategies, valuation discounts, qualified small business stock elections, cash balance plan funding before the sale. If you call me 6 months before you're selling your business, we really can't do that much. 3 years before, we can do some really cool stuff. Remember that ship steering analogy? At the beginning of the journey, small adjustments get you to where you need to go. But if you wait until the last minute, you might have to pull a U-turn, and U-turns are hard with a big ship. What's the mistake here? Waiting 6 months before you sell to start doing the exit planning. Start planning at least 3 years before your expected event. Even if the timing changes, you'll have options. Okay, let's recap the 5 mistakes. 1, operating under the wrong entity structure for too long. 2, maxing out your 401k and not exploring advanced retirement strategies like cash balance plans. 3, your advisors are not coordinating, so things fall through the cracks. 4, waiting until December to think about taxes instead of planning year-round. And number 5, not starting exit planning early enough, ideally 3 to 5 years before you sell. Look, you've worked hard to build your business. You're probably paying more in taxes than you need to, not because you're doing anything wrong, but because proactive planning just isn't happening. If you found this helpful, subscribe to the channel. I put out videos on tax strategies, exit planning, and wealth coordination for business owners. And one last reminder, this video is for educational purposes. It's not personalized advice. Tax strategies depend on your specific situation. Always consult your CPA, attorney, and financial advisor before making decisions. Thanks for watching.